spotting market reversals early is one of the most misunderstood ambitions in trading, because most people approach it like a magic trick, something you either guess correctly or miss entirely. When in reality, reversals are rarely moments. They are processes, slow shifts in behavior that only look sudden in hindsight. After living through the dot-com peak, the 2008 top, and the violent COVID reversal, I can tell you this with complete honesty. Nobody consistently picks exact tops or bottoms, and the traders who survive longest are not the ones who predict reversals perfectly, but the ones who recognize early enough that the rules of the game are changing and stop playing the old one. The first mistake people make is thinking reversals announce themselves with drama. They expect a giant candle, a screaming headline, a clean pattern that says, "This is it." That almost never happens at the real turning points. True reversals begin with discomfort, not clarity. The market starts behaving differently than it used to, and at first, that difference feels subtle enough to ignore. Trends that once moved easily start to feel heavy. Good news stops pushing price higher. Bad news suddenly matters again. These are not signals in the traditional sense, they are changes in character, and learning to notice character is the foundation of spotting reversals early. One of the earliest signs I watch for is effort versus result. In a healthy uptrend, buying effort produces upward progress. Pullbacks or shallow recoveries are fast, and price spends more time going up than going sideways. As a reversal approaches, that relationship deteriorates. You'll see strong bullish candles that go nowhere. You'll see volume spike without follow-through. Price works harder for less reward. This is the market telling you that supply is quietly absorbing demand. Most traders dismiss this phase as consolidation and keep trading the old trend aggressively, not realizing that consolidation near highs is very different from consolidation during expansion. Another early warning comes from how pullbacks behave. In strong trends, pullbacks are corrective and controlled. They respect structure. They feel boring. Near reversals, pullbacks become sharper, more emotional, less orderly. They retrace deeper and recover slower. Each bounce looks weaker than the last. Individually, these moves don't mean much. Together, they form a rhythm change. Markets are rhythmic by nature, and when the rhythm breaks, something important is happening beneath the surface. Breadth is another quiet messenger. Near major tops, fewer stocks participate in the advance. Indexes can continue making new highs, while most components are already rolling over. This happened clearly in 2000 and again before 2008. The index looked strong, but leadership was narrowing. Early reversal traders pay attention, not to the headline chart, but to what's happening underneath it. When leaders stop leading and laggards don't recover, the foundation of the move is eroding, even if price hasn't collapsed yet. Sentiment also shifts before price does, but not in the way most people think. Extremes of optimism don't cause reversals. They accompany late stages. What matters more is complacency. When participants stop hedging, stop questioning, stop imagining risk, the market becomes fragile. You'll often see volatility compress unnaturally near tops, creating the illusion of safety. That compression is not calm, it's tension. It's the market coiling, not resting. When volatility finally expands, it feels shocking, only because everyone forgot it could. One of the most important lessons I learned the hard way is that reversals start on higher time frames and express themselves last on lower ones. Intraday charts will tempt you with countless fake turns, but real reversals leave fingerprints on weekly and daily structure first. You'll see failed attempts to make progress, lower highs, forming quietly long wicks, rejecting extremes. These are not entry signals, they are warnings. The job at this stage is not to short aggressively, or catch the exact turn, it's to stop assuming the old trend will save you. Volume, when interpreted correctly, adds another layer. Climactic volume at highs often marks the transfer of inventory from strong hands to weak ones. But more important than the spike itself is what happens after. If heavy volume appears and price cannot move higher, afterward, that's distribution. If volume dries up on rallies and expands on sell-offs, that's a shift in control. Again, none of this tells you sell. Now it tells you pay attention. Perhaps the hardest part psychologically is that spotting reversals early often means doing less, not more. It means reducing size, tightening focus, and becoming more selective while everyone else is celebrating continuation. This is uncomfortable because it feels like caution at exactly the moment confidence is rewarded. But experience teaches you that late-stage trends punish impatience and overconfidence far more brutally than they reward bravery. I want to be very clear about something before we go further. Spotting a reversal early does not mean trading it early. This distinction is where most damage is done. Awareness is not action. Seeing the signs simply gives you permission to change behavior, not to fight the market prematurely. Many traders blow themselves up by being right too soon, shorting every new high, because they sense something is off. The market does not care about your insight if your timing and risk are wrong, and this is where everything starts to tighten, because once you understand that reversals are processes marked by changing behavior rather than single patterns, the real challenge becomes knowing how to respond to those early signs without turning awareness into reckless prediction. How to shift from trend-following mindset to defensive posture gracefully, and how to prepare for a possible reversal without needing to call it perfectly. And that transition from observation to intelligent response is exactly where we need to continue next, as this thought carries forward into how experienced traders adjust positioning risk and expectations when they sense a reversal forming, but do not yet have confirmation, and are standing right at that uncomfortable edge where the old rules still work just enough to tempt you to ignore the warning signs and keep pushing forward, even though something deep inside is telling you that the character of the market is no longer the same. And that moment, that internal hesitation before the crowd notices anything is wrong, is where real experience either protects you or gets overridden by habit. And that is precisely where we go next, as we continue this discussion and move from seeing reversals early to surviving them intelligently, without needing to be a hero or a prophet, and learning how to stay aligned with probability instead of ego. As the market prepares to change its direction and its tone, and its consequences for anyone who refuses to adapt. And that continuation begins exactly here, as we carry this sentence forward into the next part, where we talk about how to respond when you feel that shift beginning. But the chart has not yet given you permission in the obvious ways everyone is waiting for, and you are deciding whether to respect that early warning or dismiss it as noise and keep trading as if nothing has changed. And that decision is where most long-term survival is either earned or quietly lost, because spotting a reversal early is not about prediction, but about listening closely enough to stop, pretending the market is still the same as it was yesterday, and being humble enough to adjust before it forces the adjustment on you. And that is where we continue next, by adjusting behavior before you try to adjust direction, because the market never punishes you for being cautious early. It only punishes you for being stubborn late. Once you sense a potential reversal forming, the first intelligent response is not to flip your bias. It's to reduce exposure. This is where experience shows up quietly. Instead of asking, "Is this the top?" you ask, Do I still deserve the same size? Late-stage markets are where full-size positions do the most damage. I've learned to scale down long before I scale out entirely, because smaller size buys you clarity. When size comes down, emotions calm down. And when emotions calm down, you can actually observe what the market is doing instead of defending what you want it to do. The next shift is tightening your standards, not your stops. Many traders react to early reversal signs by pulling stops closer, which often just hands liquidity to the market and keeps them emotionally engaged in a trade that no longer fits the environment. A better adjustment is selectivity. You stop taking marginal setups. You stop chasing extensions. You require cleaner structure and better location. In other words, you trade less but with higher intent. This doesn't feel aggressive or clever, but it dramatically improves survival when conditions are changing and the old playbook is starting to fail intermittently. Another critical adaptation is changing how you interpret continuation. In late-stage trends, continuation becomes suspect. Breakouts that once followed through now stall. Pullbacks that once resolved quickly now drag. Instead of treating these as buying opportunities by default, you treat them as tests. You watch closely how price behaves after supposed bullish events. Does it accelerate or does it hesitate? Does it accept higher prices or does it immediately rotate back into prior value? This observational posture keeps you aligned with probability rather than habit. One of the most important mindset shifts at this stage is detaching from the need to be early. Early awareness is not a badge of honor if it costs you money. I've seen countless traders correctly sense major tops and still lose because they tried to monetize insight before the market had structurally changed. Being early is only useful if you are also small, patient, and flexible. If you are emotionally invested in being right before everyone else that need, will push you into premature shorts, stubborn holds, and oversized risk. The market does not reward anticipation, it rewards alignment. As confirmation slowly develops, and it often does so unevenly, your job becomes one of permission rather than prediction. Lower highs start to form. Rallies fail sooner. Support levels that once held cleanly now break and struggle to reclaim. These are not single signals, they are cumulative evidence. When that evidence builds, you can begin transitioning from defense to offense, but only incrementally. Initial reversal trades should be exploratory, not declarative. Small size, defined risk, willingness to be wrong quickly. This is how professionals probe a change in regime without betting their account on being correct the first time. Another overlooked adjustment is time frame discipline. Near reversals, lower time frames become especially deceptive. They will show dozens of convincing counter-trend moves that go nowhere. If you let those charts dominate your attention, you will overtrade noise while missing the larger transition. This is where anchoring to the higher time frame matters most. The larger structure tells you whether a move is meaningful or just a reflex. When in doubt, zoom out. Reversals reveal themselves more clearly with distance. Emotionally, this phase tests patience in a different way. Instead of the fear of missing out, you face the fear of missing the turn. Both are dangerous. The antidote is process. You follow your framework. You adjust risk. You wait for confirmation. You accept that you may miss the exact top or bottom, and you remind yourself that the middle of a reversal move is where probability and opportunity actually align. There is no prize for catching the first dollar of a new trend, but there is a heavy penalty for fighting the last dollar of the old one. Looking back over decades, the traders who survived major reversals were not the ones with the sharpest predictions, but the ones who changed their behavior early enough to avoid being trapped. They reduced size. They questioned assumptions. They stopped extrapolating the past into the future. By the time the reversal became obvious to everyone, They were already positioned emotionally and structurally to handle it. And that's the real lesson here. Spotting market reversals early is not about calling tops and bottoms. It's about listening closely enough to stop trading, as if nothing has changed. It's about humility before confirmation, patience before commitment, and discipline before ego. If this lesson resonated with you, I invite you to subscribe to the channel so you can continue learning from real market experience rather than prediction fantasies, and leave a comment sharing a time when you sensed a market turning but weren't sure how to respond. Because reflecting on those moments is how awareness turns into wisdom, and wisdom is what keeps you alive when the market quietly changes character and asks whether you're paying attention or just repeating what worked yesterday.